There are cycles that occur which make it possible for us to track in order to predict the movement of the stock market. As time goes on, we see the markets entering levels that are unsustainable. Every indicator is off the charts. Everything is completely out of whack. But have no fear, because the financial media has explained that everything is just fine. But then again, you came here for the truth, so let me unveil that for you. Today we're going to look at various indicators within the economy and the stock market. Let's begin. Today, profit margins are at all-time unsustainable highs. And there are several indicators which are at new highs, breaking records, and the unfortunate part is that there is no underlying structure to keep it afloat. Note the surge in profit margins end of business cycle before the bear markets. And you will see that occurring here during the tech boom and bust, again during the financial crisis, and they put a question mark here suggesting, could there be a time in the near future where this occurs for the third time in a row? It happened twice before. Could it happen again based on this indicator? Note how the stock prices track profit margins, and you see that over the course of this chart. It is very evident, it is very clear that these are linked together. Profit margins are cyclical, and you will see that here in this case. As I said a moment ago, if there was some underlying structure, a good economy, you would see real jobs being added that are good paying jobs. You saw people doing better in general. They're having more savings. They are able to basically not have problems with food insecurity. The whole economy, let's say, was on a path to make itself better. Then I would suggest that we can go on for a longer period of time and that there is no real major concern. Unfortunately, that's not the case. You just look at all the real indicators for yourself. A lot of anecdotal evidence. Look how many people are sleeping on the streets, for one. And you start to piece together this puzzle. If you just take single indicators, it's not good. That's not a good way to do things. If I just look at the unemployment rate, I'm never going to get a good idea of what employment is like, of what jobs are like. I need to get, maybe 50 indicators, piece them together. Okay, that's the jobs market. I figured it out. But you don't get that with one indicator or maybe two or three. That's not the way it works. That's really not the way it works. But if you look at traders in the financial industry, if you have ever been involved with any traders, they only look at a very, very small handful of financial indicators, and they are able to do their job in a way. That's fine. You can do that. But you don't really understand what underlines all this market and the whole financial structure. Now, this is another indicator that has shown to be at an all-time high. This is going back to 1928 in this case, and you're looking at the margin adjusted CAPE. Okay, so another way to look at the PE ratios. There's a lot of data here if you'd like to read it, but essentially what we're looking at is yet again a way to show us that we are off the charts. This happened during the Roaring 20s. It happened during the tech boom and bust, and we are far surpassed what happened in the housing boom and the whole, work its way up to the financial crisis. Way beyond it. And this will continue to go on. I think that there is still some life left in this bull market. I'm not denying that. Unfortunately, the cause of the bull market is central bank quantitative easing. Of course, there's significantly low interest rates compared to history. And at no point in history has there ever been this much intervention, especially on a global level. Moving on. Average weekly hours of production and non-supervisory employees. And you could see that it's nearly at the 39 mark. And that was, prior to 1970. And this has been declining. So I mention this for just one particular reason, and that is, particularly since the introduction of Obamacare, what we have seen is that there are less hours per person. What they can do is simply give people part-time hours, and they will not need to have to give them their health insurance. That's what a lot of people get. They get temporary workers, they get part-time hours, and they want to be working full-time hours. It's not people working part-time that's a bad thing. If that's what you want, that's great. But there are a lot of people out there who can only get part-time when they really want to be working full-time. That's how they skew the numbers, of course. But this has been a very big problem ever since the introduction of Obamacare. I've had many people tell me that they have encountered this as business owners as well as employees. They have told me this is the case. It's really quite unfortunate, but that's the way it is. All right, moving on. Denmark's biggest financial firm, okay? Look at what they did. They have this robot, and that robot somehow now has 11,500 clients. It's an investment service, and they're calling it June. And essentially, it does what all financial advisors will do. The average financial advisor asks you, basically multiple choice questions. What is your risk tolerance? What is your income? Very, very basic. And, you're basically going to be put into the same funds anyway. They choose the funds that are, the ones that they get the most incentive out of, maybe the highest percentage or what have you. And that's just the way it is. Look at this. With Denmark holding the world record in negative rates, the country's been below zero since 2012, longer than any other place on earth. The bank argues it makes sense to redirect deposits now earning nothing. So you're going to take people's bank accounts, the place where people want to keep their money, just as a parking spot. They don't want to earn money on that necessarily, but you have negative interest rates. So people are losing out or they're getting zero. And so they say, look, we'll put it in some safe assets for you and you'll be able to make a little bit of money. And I think this is dangerous. Number one, I think that takes it away from the fake insurance that they have and it puts it into an uninsured environment. Big problem. But I think it also goes a lot deeper than that. But this is just one important thing. I don't want to go on too far on this. Just the point that while they suggest in this article here that this isn't to replace jobs. No, it's not to replace jobs. This is just going to make jobs easier. Look around. All of these financial companies have some sort of advisor that is using a computer, basically a computer technology. And that's not for small-time clients. A lot of these businesses, they're using these for $250,000 plus. So keep your eyes on these, that's for sure. Meet your boss, an algorithm. Companies are using artificial intelligence and other elements of work-on-demand business model to automate workforce management tasks. I'll move on. Some high-income business owners could face marginal tax rates exceeding 100% under the Senate's tax bill, far beyond the listed rates in the Republican plan. I don't know what's going to happen, okay? I don't really, once this all is finalized, then we'll see. But that's a little bit surprising to me, to say the least. And I don't want to go into it too much because it's just speculation at this point. Now, if the economy was booming, if the economy was doing well, if people weren't in that much debt and they were able to sustain this, they were able to deal with it, we wouldn't have this. I'll show you just 3 quick things. Money for blood. As the global plasma industry grows, struggling students donate to survive. You just walk in and out, you get your money. Donors can make between $25 and $150 a week. And that's basically the maximum is 8 visits per month. And I know that there are many people, they show you here, that are doing so. Look at this. Why thousands of low-income Americans donate their blood plasma for profit centers. At these profit centers. So they go in, they donate, they get some money. Now look at where it's located. They actually say on this one website, right here, just minutes away from the University of Oregon. Because they know students, they are needing money. They're in so much debt. They can't get any good jobs, obviously. And what can they do? They need to make bucks where they can. So some say, look, all I got to do is sit there. They take some of my blood or my blood plasma out. I'll make some cash. And I don't think that's bad that anybody, if they want to do that. But the way I look at it is, look, if everything was doing fine, we wouldn't have this problem. We wouldn't have people doing this. But that's not the case. So that's the point I'm trying to make. I'm trying to use the statistics that you see, whether it's PE ratios, and then I'm trying to combine that with more of the anecdotal evidence. And that's important too. If you've ever been in jury duty, you would know what they tell you about this, that oftentimes the anecdotal evidence is more valid than witness testimony, than certain so-called facts that you see. That's something interesting. Anyway, so maybe one day I'll tell my story about that. If you found the video informative, please give me a thumbs up. I really appreciate all the support I've been getting, especially recently through Patreon, PayPal, all the cryptocurrencies, in every way possible. The thumbs up, the positive words of encouragement. Thank you to each and every single one of you. Okay. Last but not least, if you found the video informative, I know you'll find my books, The Money GPS, and my newer release, Global Economic Collapse, even more informative. You can actually flip through these books. If you go over to Amazon, the links are in the description below. You get to flip through them for yourself. Take care.